Hello everyone and welcome back to the channel. Let's get straight to it. We all know the robotics revolution isn't coming. It's already here. It's integrating with AI. It's reshaping manufacturing, logistics, healthcare, and even agriculture. We see the headlines about Nvidia, we see Tesla's Optimus, we see Boston Dynamics. But let's be honest, the valuations on those giants reflect a lot of that future growth already. The real, life-changing, asymmetric upside often lies in the shadows, in the small cap and micro cap companies that are building the niche, essential technology that the entire industry will one day depend on. Today, I'm digging into a high-risk, high-reward corner of the market, robotics penny stocks. Specifically, I found 4 companies all trading under $5 that I believe are sitting on massive potential catalysts for 2025. Now, let's be crystal clear before we go any further. This is the definition of speculative investing. The penny stock label is there for a reason. These are not your buy and hold for 40 years 401k stocks. These are volatile, often pre-revenue or pre-profit, and carry a significant risk of failure. You must do your own research, understand the risks, and only invest capital you are fully prepared to lose. This video is for educational and informational purposes to highlight companies that have landed on my personal watch list based on their technology and their upcoming catalysts. This is about finding potential, so with that disclaimer out of the way, let's get into the alpha. The thesis for this entire video is simple. The big players are building the platforms, but the exponential value will also be captured by the companies that solve one specific, incredibly difficult problem. The company that makes a specialized gripper, the AI vision system for sorting, or the surgical tool that enables a new procedure. When one of these small companies signs a licensing deal or a supply contract with a major player, an Amazon, a Johnson & Johnson, or a General Motors, their valuation doesn't just double, it can go up 10, 20 or 50-fold. That's the asymmetry we're hunting for. We're looking for the inflection point. My first pick on the radar is a company in the industrial and logistics space called Vectroglide Dynamics, trading under the ticker VEGGI. Vectroglide isn't trying to build a humanoid robot. They are hyper-focused on one of the biggest bottlenecks in the modern economy, warehouse fulfillment. Specifically, they design and manufacture autonomous mobile robots, or AMRs, for what's called last-mile logistics. That chaotic final sorting and packing process inside a distribution center. Their secret sauce isn't just the hardware, which is robust, but their proprietary pathfinding AI, which they call HiFleet. Unlike traditional AMRs that follow magnetic strips or predefined QR code paths, HiFleet uses a dynamic swarm intelligence model. The robots communicate with each other in real time, constantly recalculating the most efficient routes to avoid congestion. Think of it like a real-time Waze for a warehouse floor. Their internal data, which they've presented at robotics forums, shows a 30% increase in pick and pack efficiency over legacy Kiva style systems in complex, high-skew environments. So why is it a penny stock? Why is it under $5? 2 reasons. First, they have a massive R&D burn. Developing this kind of AI isn't cheap, and they are burning cash every quarter. Second, they lost a significant contract about 18 months ago with a mid-sized retailer that went bankrupt. The market saw this, panicked, and assumed the tech was a failure. The stock collapsed from over $15 to where it is today. The narrative is that they are dead in the water, just another failed robotics startup. But here is the 2025 catalyst that the market is completely ignoring. For the last 9 months, Vectroglide has been in a quiet, non-disclosed pilot program with one of the top 3 largest third-party logistics 3PL providers in the world. I can't say the name, but think XPO DHL or Caney plus Nagel. This pilot program is set to conclude in the first quarter of 2025. If this 3PL provider adopts Vectroglide's HiFleet system for even a fraction of its North American warehouses, it's not just a contract, it's a validation of the entire technology stack. This one deal could represent revenue that is 10 to 15 times their current market cap. They are also scheduled to be a major presenter at the MODEX Supply Chain Show in early 2025, where they are expected to unveil the full results of this pilot program. The risk here is obvious. The pilot fails, the 3PL walks away, and VGNI will have to dilute shareholders heavily to raise more cash, potentially sending the stock to zero. But if that pilot converts, a sub $5 entry point will look like an absolute gift. This is a classic binary event play, moving from the warehouse to the operating room. My second pick is Nano Precision Robotics, ticker NPRs. This is a medical technology play and is even earlier stage, which means the risk is even higher. Nano Precision is not trying to compete with the 800-pound gorilla, Intuitive Surgical, and their $2 million Dalton's Vinci machine. That's a fool's errand. Instead, they are developing what I call the picks and shovels for the next generation of robotic surgery, disposable micro-robotic end effectors. Think of it this way, the Da Vinci is the platform, but the real innovation and recurring revenue is in the tools at the end of the robot's arms. Nano Precision is developing smart, sensor-equipped disposable tools for highly complex procedures like neurovascular or ophthalmic eye surgery. Their flagship product is a micro-suturing tool smaller than the head of a pin that has integrated haptic feedback. It allows a surgeon to feel the delicate tissue they are stitching, something that is notoriously difficult with current robotic systems. Their model is FarRazor and Blade. They don't want to sell the machine. They want to license their smart tool technology to all the platform builders, Intuitive, Medtronic, J&J's, Auris Health. They want to be the Intel inside for surgical robotic tools. The reason this is a penny stock is simple. They are pre-revenue completely. The market, especially in a high interest rate environment, hates pre-revenue med tech. It's a cash furnace. Their entire value is based on intellectual property and the promise of future regulatory approval. This brings us to the 2025 catalyst. After years of development and animal trials, Nano Precision has submitted its 510 application to the FDA for its first microsuturing device. The timeline for a 510 review is variable, but all indications point to a decision by mid-2025. This is the single event that matters. FDA clearance is the gateway. It unlocks their first commercial revenue, it validates the platform for licensing discussions, and it turns their technology from a science project into a commercial asset, the risk binary, utterly binary. If the FDA requests more trials or rejects the application, this stock could lose 90% of its value overnight. Competition is also fierce, as the big players are all trying to develop their own tools in-house, but the potential reward is staggering. A single licensing partnership with a major player post-approval would prove their FEI platform agnostic FEI model works, and the market would have to reprice the entire company not as a pre-revenue gamble, but as a high-margin, recurring revenue medical device company. This kind of in-depth analysis is what this channel is all about. We're not just scratching the surface here, we're building a thesis. If you're getting value from this kind of breakdown, do me a solid and hit that like button. And if you want to make sure you don't miss future deep dives, hit that subscribe button and turn on the bell notification. It helps the channel immensely and ensures you see this content first. My third pick is a different beast entirely. It's not hardware, it's a pure software play. The company's Cognitive Drive Systems, ticker COGS. Cognitive Drive is tackling what I believe is the single biggest hurdle to mass robotic adoption, interoperability. Right now, if a factory buys a robotic arm from ABBA, a welding robot from Fanuc, and an AMR from Zebra, they all run on different proprietary software. They don't talk to each other. It's a closed-off, inefficient mess. COGS is building the Android OS for robots. They've created a hardware agnostic AI-powered operating system that allows disparate robots from different manufacturers to collaborate in a single unified environment. Their key technology is a Fleet learning FEI module. When one robot on the network learns a new, more efficient way to perform a task or navigate an obstacle, it uploads that learning to the central COGS platform, which then pushes that update to every other robot in the fleet, regardless of manufacturer. This is a game changer for digital twinning and factory simulation. A company can design an entire production line in the COG simulation software using virtual models of all the different robots they own, and the AI will optimize the workflow before a single physical robot is moved. Why is it cheap? Because this is an incredibly complex, abstract product. The sales cycle is brutally long. They aren't selling a faith in Faye you can point to. They are selling an ecosystem. They are selling a new philosophy of automation. The market doesn't know how to value it. Is it a SaaS company, an industrial company? This uncertainty, combined with a small, recent secondary offering to raise cash for sales expansion, has kept the stock price depressed. The 2025 catalyst is twofold. First, they are launching Faye Cognitive Drive 3.0 Faye in the second quarter of 2025. This major update is slated to include their groundbreaking simulation to reality transfer module, which promises to cut robotic deployment time from months to days. This is what industrial clients are waiting for. Second, and more importantly, are the persistent rumors of a major partnership with a new era automotive manufacturer. I'm talking about one of the big EV gigafactories. These new factories are the perfect greenfield environment to deploy a unified OS from the ground up rather than trying to retrofit an old established factory. If COGS announces a partnership of that scale, it proves their concept works and that manufacturers are willing to adopt a third-party OS to escape the walled gardens of the hardware makers. The risk is significant. Will manufacturers ever really give up control of their proprietary software, which creates a sticky ecosystem and recurring revenue for them? Or will COGS be relegated to a niche player for small-scale system integrators? It's a battle for the soul of the automated factory. But if they win, COGS won't just be an OS, they'll be the OS. For my fourth and final pick, we're going outdoors. The company is HarvestBot Innovations, ticker HVST. This is a specialized robotics play in a sector that is often overlooked, but is facing an existential crisis: agriculture. HarvestBot develops autonomous robotic systems for high-value, delicate crops. Think robotic strawberry pickers, apple harvesters, and vineyard pruning bots. These are incredibly difficult mechanical engineering and computer vision challenges. You have to identify fruit ripeness, navigate unstructured, muddy terrain, and gently pick a delicate piece of fruit without bruising it. All at high speed. The need for this is non-negotiable. There is a structural, permanent labour shortage in agriculture. Farmers are desperate for a solution. HarvestBot's technology, which combines advanced LiDAR, 3D vision and delicate multi-fingered grippers, is one of the few that has shown real-world success. So why is it a sub-$5 stock? It's a tough, low-margin business. It's seen as Faye-dumb Faye robotics compared to sexy AI or surgical plays. Furthermore, the business is cyclical and seasonal. They had a disastrous third quarter last year because a severe drought in California, one of their key markets, meant many of their farm customers delayed capital expenditures. The market punished them and the stock fell off a cliff. But the market is missing the monumental shift in their business model that is happening in 2025. HarvestBot is moving away from selling a $250 robot. That's too much capital for most farms to risk. Instead, they are launching their Faye Robotics as a service, Faye or RaaS model starting. In the 2025 growing season, farms will no longer have to buy the machine. They will subscribe to a harvesting service, paying HarvestBot per hectare or per pound of fruit picked. This is brilliant. It does two things. First, it dramatically lowers the barrier to entry for farmers, massively expanding HarvestBot's total addressable market. Second, it transforms HVST from a lumpy one-time hardware seller into a high-margin, recurring revenue subscription company. The market has not priced in this transition. It's still valuing HVST as a failed cyclical hardware company. The 2025 catalyst will be the first and second quarter earnings reports for 2025, which will be the first time we see the revenue from this new RaaS model. If they can show strong adoption and high margin recurring revenue, the entire valuation thesis for this company changes. The risk is execution. Can their machines maintain the uptime and reliability needed for a service model? A broken down robot during peak harvest season is catastrophic. And there's always the threat that a giant like John Deere decides to enter the specialty crop space and crush them with superior scale and distribution. But the pivot to RAS is the key, and 2025 is the year it proves itself one way or another. So there you have it. 4 companies on my radar, all under $5, all in the explosive robotics sector, and all with major potential inflection points coming in 2025. We have Vectroglide Dynamics, Vegdani, in logistics, nano precision, NPRS in medical, cognitive drive, COGS in AI software, and HarvestBot, HVST in agriculture. Remember, these are high-risk speculations. Do not bet the farm. But this is the kind of research that uncovers hidden gems. The goal is to find tomorrow's winners before the rest of the market even knows their name. It's about understanding the technology, identifying the catalyst, and having the conviction to watch the thesis play out. I want to know what you think. What robotics trends are you watching? Are there any hidden gems? Any under the radar robotics companies, penny stock or not, that you believe have huge potential? Drop your thoughts and your own picks in the comments section below. I read every single one. Thanks for watching. Stay curious, stay disciplined, and I'll see you in the next one.